What's up, you guys? It's Paul here. In this video, I wanted to talk to you about whether we are about to see a stock market crash after the recent pullback that we've seen, and how and what kind of strategies that I'm using to tackle this volatility in the market. Okay, so as you've been paying attention to the stock recently, the S&P 500 dropped by over 4% recently. The Dow dropped by about 3.3%, and the Nasdaq fell the most by 6%. Okay, and the reason mainly for this is because we're seeing a bit of a sector rotation here, where a lot of these high-flying tech stocks had to drop because they've been going up pretty much in a straight line for the last few months, and so they started slowly transitioning into other S&P 500 and Dow stocks into other sectors out of the tech industry. Okay, now whether that really contributes to a crash or not, we have yet to see that. But here's what my thoughts were. Okay, so to me, the way I see it, based on the trends here, I see this as more of a reversion to the mean. Okay, so if you see the shaded area here, those are called the Bollinger Bands, where the middle line is your 20-day moving average, and the top and lower lines are your standard deviations. Okay, so the stock market always goes between these two lines all the time, and it keeps testing the average line, tests the lower line, goes back up. And when you're constantly in an uptrend like this, where you keep testing the upper standard deviation of the Bollinger Bands, at some point there is going to be a little bit of reversion to the mean. Okay, and as you can see here, we clearly just hit the mean here around 342 here, and until we know if it's going to go all the way back, we won't know that yet. Okay, another test or support that I'm looking at here, a relatively strong support, would be the 50-day moving average here, which is around 329 for the SPY. Okay, now after that, there are further supports that you can draw around here, around 326. You can see further supports down here, as well as at 323. But the strongest support that I would see is the 200-day moving average down here at 308. Okay, so if you really see a fast crash, then the worst it can do is test the 200-day moving average, and if it bounces off of that, then we're off to the races. Okay, but in my opinion, I think this is just more of a reversion to the mean. It may drop a little more here, test the 50-day moving average, and move back up, but there's a good chance that we may start seeing a little bit of a turnaround. Okay, I don't know that yet, none of us do, so that's why I pay attention to these support lines and a lot of these moving averages to ensure that we're on the right track. Okay, now if you watched my video on how best to time the market, the MACD line is one of the factors that I talked about. Okay, so anytime this leading indicator crosses over the lagging indicator, that's usually a sign that we're about to go on a downward trend, but we are still way above the zero line. Okay, so if you compare it with the crash that we saw here, we saw the most damage once they actually crossed the zero line. And once they crossed, until they crossed back here, we weren't in a confirmed bull market yet, or confirmed uptrend yet. Okay, so out here, as you can see, it's still way above. And even here, we saw that this came over here. This looked like a scary drop, but it bounced off the 200-day moving average, tested it again, and started going back up, and the MACD line never went below zero. Okay, so that's another big test that I look at before deciding whether we're really going to crash yet or not. Okay, now the strategy that I'm using was actually recommended by Danny Alvarado. Danny, if you're watching this video, thank you so much for sharing this. It's a very effective strategy, and the strategy is called the Strangle. Okay, now I typically use the Strangle around earnings, because around earnings, stocks tend to move up or down a lot, and that's when you buy both a call or a put, one of the options tends to skyrocket while the other can expire worthless. But because one of them skyrockets 300-400%, you still end up profitable on the other end. Okay, but in a really volatile market like we are seeing right now, even there, the Strangle actually works out really well. Okay, so I got strangles on a couple of stocks here. One of them was Tesla, where I got this September 18th 620 call, and I also bought the $305 put here. But if you look at the history of the put, it shot up a lot today, reached as high as 1045. My average cost basis was only 565. And then I wasn't sure if it was going to keep falling, so I kind of waited patiently. I started seeing that the put started going down, meaning that the stock price was going up. So instead of selling out of this, what I actually did was, since I was confident that Tesla will not reach $305 by September 18th, I decided to convert this into credit spread and sold the $310 put instead, okay? And I got a credit of $950 for it. So if you saw the amount I paid for the put here, I paid $565 here, and I sold the 310 put for $950, which is approximately a $305 profit that locked in, okay? Now on the call side, I paid $595 for it. It's down $107, but you know, Tesla tends to move up a lot and down a lot. It's a very volatile stock. So in the next 2 weeks, at any point, if Tesla does shoot up 5 or 10%, like it does a lot of times, this call is going to shoot up a lot. And instead of selling out the 620 call, I might decide to turn that into credit spread and sell the 600 call or the 610 call, depending on how much credit I'm going to get out of it, okay? Now, another stock that I did this on was Apple. I already sold out of it, so you won't see it here, but I got a Strangle for $1,104 here. I got 3 of the 107.50 puts and 3 of the 135 calls. I paid $170 for 3 of the puts, and because Apple did go down a lot, I sold out of the puts at $385, which is a good 125% profit in a 1 day, okay? Now on the call side, I sold it at a bit of a loss, but honestly this was a lesson learned for me because Apple did turn back around, and these same calls are now worth $170, so I could have potentially made an extra $300 from it for the 3 contracts. But I still, if you do the math, I still came out profitable for a quick $200 or so here, okay? Now another stock that I did this on was Nvidia. Now with Nvidia, what I did was I actually had a 515 put, but I sold out of it too early. I did make 100% profit, but I saw that it was still coming down. So instead I went and bought the 420 put. I paid $600 for it. Now the thing is, again, even this one shot up a lot during the day, went up to 930, and I started seeing that it was coming down. So again, instead of selling out around 700 or 685 with barely making a profit, I decided to sell the 425 put for a credit of $900, okay? So even there, it was a quick $300 profit. So all these are in the same day. So in the same day, 300 on Tesla, about 200 on Apple, 300 more on Nvidia. It was like a quick $800,000 profit on all these stocks just by using the Strangle strategy, okay? Another one that I'm still holding on is Fastly here. So with Fastly, I got the October 16th Strangles instead of just the 18th, just to give myself a little more time. And in this case, I bought 2 of the $100 calls and 2 of the $55 puts. And another reason why I did this is because Fastly also is a really big mover. I think they've gone down a lot. They may or may not go down more, but if it shoots back up, a lot of times Fastly goes up 9-10% in a single day, okay? And when that happens, I'm sure the $100 call will spike. We already saw a bit of a recovery today, so I paid $340 for 2 of the calls. They're already up 39% here, but I'm down quite a bit on the put side, down 57%, so I'm actually down more on the put than I'm up on the call side, so that's why the overall Strangle is still down $30. But I just need 1 or 2 of those days where it shoots up a lot or crashes furthermore, and I'll make profits on either side of it, okay? I would do the same thing if you're getting really close to $19.95. I will probably sell out of the call, and depending on what price it's at during the last week, I may turn this into a credit spread, but if not, if it's getting really close to 100, I might just sell out of the $100 call here. But otherwise, this is another Strangle that I'm using on Fastly because these are all big movers, okay? So that is the key, to find stocks that move a lot, either on the upside or downside. Use these really far out of the money Strangles, let them appreciate, and then sell a call or a put below them or above them respectively for calls and puts to turn them into credit spreads and maximize your profits, okay? So that's all I wanted to share with you guys here today. I hope you found that helpful. If you have any questions, please leave them in a comment below. Smash that like button for the YouTube algorithm. And subscribe if you haven't already, and hit that notification bell to get notified of my future uploads, okay? And thanks again for watching, and until next time.